James Knightley, Chief International Investment Officer at ING is with us now. James, thank you so much for joining in. We're sorry, just went off topic. We're discussing the huge Mumbai rains, big monsoon rains this morning here. But let's get back to the big story, which is, after the jobs report, now we have the consumer inflation print in the US, and everyone's saying we're getting a Fed rate cut. But I want to start with what you thought of the way the equity market is, interpreting this. Is it really, back to risk in a big way?
I'm a little bit cautious. The Fed are cutting for a reason, and that's because the economy is cooling and inflation is also cooling. So I do have a fear that we will see corporate earnings coming under a little bit more pressure. I think for now, there's just a little bit of optimism that, yes, we're finally going to get the interest rate cut. This could help cement this expectations of a soft landing. And as a result, we're seeing a bit of money flowing out of the tech sector into the broader economic sectors of the market. The divergence between tech and everything else has been so vast. From a valuations perspective, it may well make sense to just do a little bit of rotation, but medium to longer term, as I say, the Fed are going to be cutting interest rates for a reason, and that is because the economy is weakening. And as the economy is weakening, corporate profits are going to be weakening as well. And that may make further gains in equity markets later in this year more hard to come by.
That's interesting you say that, and it's good to remember academics 101, right? That's the way logically it should work. But the market gets excited at the prospects of a rate cut because then, cost of money will go down. And we saw that play out in the bond market yesterday as well. So just on bonds, what's your expectation? How much has the market priced in? I mean, are these cuts already priced in at about 4.22 on the 10-year? Or are you expecting a further drop in yields that could, for the time being, at least power the equity market as well?
Yeah, I mean, we think, we've been looking for three things for quite some time for the Fed to become comfortable about cutting interest rates. One is, of course, a series of 0.2 month-on-month or below inflation prints, and we're seemingly getting those now. We've got a really good one today. Secondly, we're looking for the unemployment rate, which has gone from 3.4% up to 4.1%, perhaps rise a little bit further, say 4.3, 4.4. And I think that is the pathway that we're on. And then thirdly, we're looking for the consumer sector in the US, which of course has been that huge engine of growth, to start cooling. And remember that growth was coming in at an annualized 3.5% consumer spending growth in real terms throughout the second half of last year. Through the first half of this year, we're coming in at 1.6, so it's more than halved. And that cooling of the consumer, coupled with lower inflation, coupled with rising unemployment, as I say, is why the Fed can start to become more comfortable with the idea of rate cuts. And we think they're not going to just stop at one. We think there's going to be a whole series of rate cuts. So yes, I do think Treasury yields are going to fall further. I think we'll probably break below 4% in the next few months as well, once those rate cuts really start to come through and the market really starts to have something to really play with. And I think, in the initial phase, equity markets may like that. But as again, we come back to the point, if the Fed are having to cut rates more aggressively because of a cooling economy, that's going to feed back into corporate earnings. And I think that's going to be the dominant story as we move into the latter part of this year and into the early part of next year.
Okay, so you're expecting a whole series of rate cuts by the Fed. That's interesting. James, thanks a lot for joining in. How are you feeling about emerging markets like India? Because this has been a great space, record highs. We have a big union budget upon us. Earnings have been picking up even in beaten down spaces like technology, for example. Is this a market that will continue to be top of mind, top of the pecking order of global investors?
Yeah, I mean, the economy is still performing pretty well. And as you say, your interview with the RBI governor, suggesting that there's there's little imminent chance of another rate cut or a rate cut starting. So the economy is looking pretty solid. And I would have to say, that the world is kind of split in three different peer groups right now. You've got those that have already started to cut rates, such as Latin America, Eastern Europe. It's now been followed by the European Central Bank and the Bank of Canada as well. There's a group that we think that are going to be on the cusp of cutting, the Fed, the Bank of England. And then there's those that there's very little prospect of any cuts and possibly even rate hikes. Japan, Australia in there. And I think India can be put somewhere between that second group and the third group. But, there are certainly still parts of the world that are firing on all cylinders and doing very well. So we've got this sort of diverging story. And I think that's going to be very interesting, currency markets and rate markets as well.
All right. Hi, James. Good morning and good to see you in. What about, in terms of emerging markets? You were a little bit cautious on the Chinese markets the last time we chatted. What about this toss-up between India as well as China? Because we've got plenty going for us, but valuation-wise, we're not very, very cheap. Though we have earnings growth, and that's something that you've been focusing on. While China, valuation-wise, is attractive, but there are various sore points in the economy and earnings as well not really showing up.
Yeah, we've been a little bit wary on China for quite some time, and I think one of those key threats is, of course, US election risk as well. We've had Donald Trump, who's doing very well in the polls in the wake of Joe Biden's disappointing, shall we say, performance at the recent debates. He's coming under real pressure there, and Donald Trump does look as though the expectation of a Trump victory is rising. And if that is the case, what are some of his key proposals? Well, a key one is that he's going to slap tariffs of 60% on all products coming from China into the US economy, and looking to ban within 4 years the import of Chinese pharmaceuticals, electronics, and other goods as well. Other countries are not going to get as much of a battering, shall we say. Most other countries are facing a 10% tariff under a Trump regime. So, there's a little bit of caution about that China story, not just domestically, but also politically on the global stage as well.
Okay, James, thank you for joining us, and appreciate your time here and your comments on CNBC TV18. That's the Chief International Economist at ING talking about a series of rate cuts that he's expecting from the Fed over the next many weeks and months. And he's seeing money flow out of the tech sector and into other sectors. But for our own markets, the tech sector will be top of mind after a good set of numbers that came in from TCS, and the fact that, sentiment is expected to pick up post those numbers. So more on